Okay, we wanted to talk a little bit today about risk mitigation. Investors are constantly being asked to evaluate the difference between investments, and it becomes easy to look at the projected returns and make a decision on that alone. But really, a full assessment also looks at the underlying risk. At Romano, we do a lot to mitigate risk where we can, and some of those things are obvious, like decisions we make on what to invest in and how the market knowledge impacts those decisions. But there's also structural things that we do too to mitigate those risks. Can we talk about that a little bit?
Well, preserving capital is the paramount concern in all of our offerings. So whenever we look at a project, we're looking at how we can mitigate risk, as you mentioned. There's a few different ways we accomplish that. One is we have a vertically integrated company, which means we control several of the different points of the development throughout the process. This gives us an ability to predict better, more accurately, when we're going to return an investor's original investment and give them a return.
Okay. So
that helps.
Yeah. We also talk a lot about the different types of risks. There's the big one, risk to your principal, which you just talked about, but the other side of that would be the liquidity risk that we talk about frequently. What is the difference?
Well, I think that's key. You have to go into a real estate project, any real estate investment, knowing that plan A may not happen. And if that's the case, what are you going to do? Do you have the ability to maintain that asset over time, to hold it without losing it? So it really comes down to, well, why do people lose their investment in real estate? Why do they lose a piece of property that they would have? A huge reason would be debt. They take on more debt than the property's worth, or maybe they get a loan when they're getting have a tenant in there receiving a rent to pay for that loan. Then the tenant leaves, they can no longer afford the rent, and they leave.
So then they can't meet their debt service obligations,
Right.
The bank takes it back. So you're saying that the way to lose money in real estate is if you're forced to sell at an inopportune time. Is that fair?
That is fair. So there's two things an investor must accept when they're investing in real estate. One is it is an illiquid investment. With all our vertical integration, with all of our planning, and the fact that we're doing this all of the time, to the best of our ability, we're still going to miss deadlines on when the project is going to sell. We couldn't have predicted COVID. There's a lot of different things that we can't predict in the market. Market cycles are the biggest factor to this. So what we do is try to mitigate those.
Great.